In the next several videos, we're going to be exploring risk and return. So what topics will we be discussing? We're going to talk about some basic concepts, standalone risk. We'll ultimately move our way into talking about portfolios, and then the theory that connects risk and return, referred to as the capital asset pricing model. In the end, we'll also discuss something referred to as the efficient market hypothesis. So we'll be exploring where prices seem to live in equilibrium, and then what might make prices change. That refers to this idea of market efficiency. So when we're thinking about risk, what are we talking about? We're talking about the things that impact this bottom denominator here. What are the things that affect risk? Debt equity of the company's other business risk, the economic types of impacts on investing in general. All of these things affect the cost of debt, the cost of equity, and also ultimately the cost of financing the company, the weighted average cost of capital here. So the risk is embedded in all of these things. And certainly there is uncertainty in the numerator, right? The free cash flow that we think we'll receive in the future, by definition, is uncertain. So what is the definition of investment returns? Don't need to talk about this much. We know that there is a change in the value of an asset. It can be expressed in dollar terms. It could be expressed in percentage terms. With investment risk, it's a little bit more complicated. So investment risk is exposure to the chance of earning less than what you expect. Now, the challenge with this is it really does not explore all of the outcomes that are possible. So in general, we know the greater the chance of return, different than what you expect, the greater the risk. So that's why I have my what I refer to as a better definition. Since we're going to use standard deviation to measure risk, what is the definition of this formula? Because this formula measures total risk. It measures the chance that a return that you expect in the future does not happen. This implies that this could have both positive and negative outcomes. So let's look at an example. First, this data comes from some analysis that we've done. We've been exploring a particular company. We have forecasted what we think is going to happen in the economy. Is the economy going to be in its best case, or will the economy be in worst case, or somewhere in between? We certainly will need to determine these probabilities, and a good statistics course, some conversations with some economists should allow us to formulate some form of probability of the future. But based on what we think these economic conditions are, we need to predict a future price. If you predict a future price, you can predict a return, right? So if we were at, let's say today's price was $100, in a very best case scenario, we think the price will go to $126. That's a 26% increase in value. So let's continue thinking about these statistics that we're talking about. This is all based on a continuous probability, right? We know that there's a percentage chance of every return to an infinitely negative number to an infinitely positive number. And this normal distribution curve can be segmented into pieces. This piece is plus 1 standard deviation. This piece here minus 1 standard deviation. So when we get to standard deviation, keep this in mind that standard deviation essentially measures a distance. It talks about the probability that something will be different if the mean is in the middle. This is a little bit off line here. The 0 should make, well, this is the mean, right? If the mean is in the middle, there's a chance that it could be less. There's a chance it could be more. This will help us understand the greater this range, the more chance it could be different from whatever the mean is. So to calculate expected returns, we need to take the sum of the product of the probabilities and the returns. So here you can see the basic formula here. Now we could do this in Excel with this formula. It's the sum product, probabilities, and returns. So if you had two columns, this is the probabilities, these are the returns. You highlight this, then a comma, then you highlight this, put the parentheses. That will calculate, and will multiply the probability times each return, then add them all up. How do we do standard deviation? And this is the risk of an asset held all by itself. It measures its total risk. That's total risk. So it measures dispersion. How are things spread out? And again, as I mentioned, the greater things are spread out, the more chance that something will happen that's different from what you expected to happen. So standalone risk, or standard deviation. Variance is how we start this, sigma here, and then it's the product of the probabilities times return minus the average return, and then you square that. The standard deviation itself is the square root. So to find variance, you take sum product, probabilities, then your returns of 1, and then returns minus the average, and then the returns minus the average so that it's squared. That will be the sum product, that is variance. Find the square root of variance gives us standard deviation. So let's look at the statistics here. Here we have those two assets. Asset A has a 6% rate of return. Asset B has a 1% rate of return. Standard, again, this is average, right? That's the average return. Standard deviation, we're measuring risk, 10.9, 7%. So we would say that A is a little riskier than B. We also have a statistic called coefficient of variation. This is useful in trying to make some comparisons. Coefficient of variation is the risk for every unit of return. So for every 1% return, how much risk do we have? And what you find here is that the coefficient of variation for A is 1.8, and the coefficient of variation for B is 7.05. So if you're comparing the risk of these two assets, standard deviation doesn't give you a good number. And if you look at the reason for that is, it's the magnitude of the numbers influences standard deviation. And that's more of a statistics kind of question. But if you were asking which one of these is the riskier assets based on returns, coefficient of variation says asset B is riskier than asset A. So how can we understand a little bit more about standard deviation? If the returns are normally distributed, the outcome will be more than one standard deviation about 31% of the time. So 16% of the time it'll be below the return, 16% will be above the return. If the return is 6%, standard deviation's 10.95, roughly 11, then 32% of the time the return is going to be between negative 11 and 17. Just take 6 minus 11. That gives 6 minus So it's in this range between negative 11 and 17%. So why is this useful for comparing investments? We know we're concerned about the time value of money. We've talked about different compounding frequencies. This also is just that additional piece that we have to understand the exact return we're going to get, or at least what we expect to get. So investments with bigger standard deviations should have more risk. High risk doesn't mean you want to reject the investment. You just need to know what that risk is and understand that you want to get paid a little bit higher for that asset over another asset with less risk. Look forward to talking to you in the next video.